So Zachary Rain
Yes,
of
sir.
Rain Finance. Before we get into all our lovely controversial topics and discussions for today, which by the way, you pissed off a lot of people on our last episode talking about the Toronto Maple Leafs, which we're not going to talk about today, I promise. But you sure got them stirred up with some of your thoughts, and I stirred them up with my thoughts. And people seem to love controversy. So when you're not giving controversial talks on professional hockey and the Toronto Maple Leafs, Zachary Rain, how is life at Rain Finance?
Life at Rain Finance is bliss. It's been very busy, so that's a different story, but it's nice. You know what? I get to help a wide variety of people, whether it's, through insurance, investments, or financial planning, or group benefits. I actually was just on a group benefits call before we got on, and it's a lot of fun. No 2 days are the same, which is another reason I like the job. And I get to meet just some of the most amazing characters. I've met, foundational charity leaders, people who are on the boards of hundreds of millions of dollars of charities. And, then I meet people who just had their first child, they just bought their house, and they got, they're all bright-eyed, bushy-tailed, trying to plan their future. So it's a fun job. I can't keep busy enough. And I'm very fortunate. So yeah, it's fun.
Do you have any clients or characters that are more interesting or strange than I?
Give you a run for your money. I don't know. I wouldn't say more. I have one who's very interesting. I'm trying to see if I can get him for your podcast, but he's very. I'm trying to get two people actually. One is like I said, a very very big influence in real estate, in charity planning, all those kinds of things. And then another one is actually a big time accountant from the eastern side of our country, and he is big into crypto. A lot of hot takes from him. So trying to get both of them, but I got a couple of people, none as interesting as you though. I know none as interesting as the chosen lawyer.
Is the first one Drake?
No, you know what? I don't find Drake that interesting. He's also a client. No, I'm just kidding. But he's not as interesting as you. Yeah, I wish. Aubrey, listen, if you're out there, buddy, and you need any financial advice, Rain Finance, we're your people.
Mr. Aubrey Graham, as you are watching this, you and I both know that you are far more interesting, but we'll let that one go. Zach is just joking, of course.
Oh, of
But
course.
I have known people that exercised with Drake at the same gym. I think somebody may have been in line with him for smoothies. We got lots of connections out there. So we're like 1 degree away from Drake. But if he called and begged to come on the show, I would reluctantly accept. And I'll even talk about whatever he wants to talk about, whether it's Rolexes or Jamaican patties or whatever he's into that day. By all means. Before we get into even more layers, though, as far as because I have some stuff that's on the brew, which you don't even know yet that we're going to be discussing. Some we've already talked about. I found some good stuff. But the first and foremost for the bread and butter is you are in the business of making people money, helping people keep their money, grow their money, and be fiscally responsible.
Yes, sir.
So one of the first things you brought up today to me as an idea, and I thought that was the coolest sounding name, was infinite banking.
Yeah.
So tell me, Zach, infinite banking, is that like when I go into a bank and I get a checking account that has no fees whatsoever, and I could do anything, pay any bills with this account? Is that like an unlimited bank account? What is infinite banking?
It's got unlimited money for you. No, it's this concept. It's taking social media by storm, which is fantastic because, like one of the biggest things in my platform and what we do at Rain Finance and just through all our medias is informing people as best as possible, right? Like I'm an advisor. I don't tell people what to do. I give them advice and I make sure they're informed. That's my job. There's obviously planning aspects to it as well, but that's the main part of the job. And so I'm finding people all over the place, TikTok, Instagram, Facebook, LinkedIn now is popping about infinite banking. And I love that people are talking about it. It's a more popularly known strategy in the US just because of their tax rules, but it's coming to Canada in a big way, especially Toronto and Vancouver, which is fantastic. I've actually had many people call me from Vancouver to discuss this in the last month, which to me is amazing, just the reach of social media.
And you're based in Toronto, Ontario, Canada, as am
Yes,
I.
sir.
But you do you service people all over Canada?
Well, not all over yet. So what happens is when you have insurance licenses, you're provincially licensed, but it's kind of like a one sheeter you just send to the government and all the different regulatory bodies across the country, and they'll either give you a quick acceptance, ask you some questions, things like that. So I'm in the process of getting licensed for British Columbia because of these couple individuals in Vancouver who we're going to do infinite banking for.
Get
Um,
ready, British Columbia. Grab your checkbooks and get ready because Zachary Rain will get regulated and licensed in your province, and he'll be helping you make some money and save your money as well. Go on, Zach.
No, thank you. It's just honest to God, it's the real estate side of things, right? So a lot of real estate investors are coming to me for this just because that's the kind of mindset they have. And I'll explain the strategy in a second. But obviously, you have the two hubs of the country where real estate is absolutely popping in Vancouver and Toronto. And so that's just where people are reaching out to me. But infinite banking, basically, it's a strategy that's actually been used for almost 100, I think 130 years now. It's not like it was just introduced today. Rockefellers used it to build their empire. This guy, you may have heard of him, his name is Walt. He owns this little shop called Disney World. He used it to finance the Orlando studios. So it's or that's Universal Orlando theme park, whatever you want to call it. So basically what it is you buy a permanent life insurance policy, which, I want people to compare it to kind of like a house. You like your primary residence, at least in Canada, where it's insurance in a traditional sense where you have a death benefit and coverage in that way. So that purpose, it's great for estate and tax planning. And I'll explain how the strategy is really applicable for a lot of people in a second. But you have cash value. And a lot of people don't know that because they think term insurance is just like you buy it once and you forget it, and there's no really
For
portion
the
to it.
people, so Zach, for the people out there that tend to be sold life insurance, what they know is I'm paying this amount every month. If something happens to me, this is how much my estate is going to get. But at some point, if I bought it for 5 years, 10 years, and I have my guaranteed rate, then all of a sudden, when that time is up and I keep going, my rates go up, right?
Yeah, so that's exactly. No, listen, that's a great understanding, and that's term insurance, right? So let me take a step back then. There's three main type of insurance, life insurances out there. There's what we call term insurance, which is temporary. Then there's permanent insurance, and a permanent insurance, that's for life. There's universal life and something called participating life insurance, or some people call it whole life. Okay. Term insurance is exactly what you're describing. You buy it for, and you can get it at different metrics depending on who you go to, but most commonly it's 10-year term 10, term 20, term 30, or term to age 65. Depending on your age, you choose one of the four options. And it's like you said, guaranteed rate for however long the term is. After that, it's often renewed, which a lot of people don't pay attention for. Everybody, PSA out there, check when your renewal is, because renewals are automatic. So that means if year 10 just ended, you finished your payments, the insurance company will renew it for another 10 years, or it could be on an annual basis. And your premiums, you will see them skyrocket. The reason is if you are not healthy, you get the insurance renewed automatically. If you are healthy enough to just go buy new insurance, the rates will be significantly cheaper. So the insurance company's assumption is, oh, they're renewing it, which means they must not be healthy. So we're going to charge them a lot more because it's going to be a greater risk and cost to us. So that's term insurance. That's the temporary side of things. That's what most people think about. Permanent insurance, on the other
When
hand,
when they're usually shopping around, they'll say, "Oh, here's all the different levels of insurance. Well, this is the cheapest, so must be the best." And thinking of
yeah,
short term versus long term, right?
exactly. And for term insurance, it's a temporary need, right? So you have a mortgage done in 25 years, get a term insurance policy for 20, 25 years, and you can just have that to cover the cost of the mortgage should one of you die, right? Same thing with kids. Most families support their kids to age, anywhere between age 18 to 25. So if you have to support them financially, and God forbid mom or dad passes away, they need extra money to support the family moving forward, right? But again, you don't need that for life because eventually your kids become self-sufficient, they become adults, and then you don't need to support them financially, right? So those are things that just basic temporary needs. When you have permanent needs, which not everybody has. I would say the common individual doesn't necessarily have permanent needs, but some individuals do. They have them for life, right? And more often than not, it's a tax and estate planning type of thing. But in that case, you need permanent insurance. You have whole life insurance or universal life. Universal life insurance, it used to be a lot more. Now it's kind of what you see is what you get. So it's term insurance in the same sense that you buy a policy, the rate is guaranteed for life, and the benefit amount doesn't change, but it's permanent, so it's for life. It used to be something called a T100, which was termed to age 100, which is essentially permanent insurance. I don't know why they called it that. I think that's why they got rid of it, because not too many insurance companies offer it anymore. But if, for instance, John, you said to me, I want to leave my kids $300,000 in, I don't want anything fancy, I want something affordable, then that's what we do. Universal life, 300 grand. And we just, set it out and let it go. Not the best option anymore because the growth features are really limited. And because inflation is going to erode the value of it. So what a lot of people are doing is turning towards whole life insurance, which is where infinite banking comes in, right? We have a policy, think of it like a house, right? There's no down payment, but if the house is worth 1 million bucks and your insurance benefit is 1 million bucks, well, this is what it's going to cost you every month or every year on an annual basis in order to maintain that policy and potentially even have it grow in value, right? Your house, it's no secret in Toronto, you buy a house for 200 grand 30 years ago, right? Now the houses are worth $2.5 million, right? It's no different with insurance. It grows in value, right? Your property appreciated in value and your insurance will appreciate in value. And there's many components to it because when you buy this type of insurance, you're essentially investing in what's similar to a fund. And the fund is investing in other things. There's investment managers and you earn a return. But the main point of whole life, which is beautiful, right? You have a payment that's split into two portions. Okay.
Mm-hmm.
You have, just like your house, portion goes towards interest. You're never going to see that money again. And then a portion goes towards your principal, which is equity, right? That's how people end up owning their homes after 25 years, let's say, right? Well, the life insurance portion is amazing. It's just like the interest, it's a small amount. So if you do, let's say $100 a month, which is very low for infinite banking, but it's just a round number. So let's say you do $100 a month, $5 goes towards the cost of insurance, $95 goes towards pure principal equity cash value. And the beauty of this is this cash value, once it's in there, it's not guaranteed to be there, but once it's in there, it'll never go down. So if I went up to you and said, John, I have an asset, I guarantee, contractually speaking, backed by a company that's worth $100 billion, it'll never go down. Will you give me a loan against the value of the asset that'll never go down?
Seems like a no-brainer to me.
And that's why the banks are doing it.
So this sounds to me, it's called life insurance, but in fact, it's like having a savings account. Really, you have a fee to keep
Yeah.
the account going, and you're just putting money away like you would in a savings account, except it's kind of protecting you from yourself and giving you flexible options in the future.
Exactly. So a lot of the
Hmm.
people that I work with, and this is done on a grand scale. So it's not $100 a month. If you're doing infinite banking,
Mhm.
you've already, your TFSAs are fully funded, your RSPs are fully contributed. You have no problem making payments towards your home, RSPs maybe for your kids. Maybe you've bought a property out there, maybe you have non-registered investment portfolio. All of these things should be considered before you take on this kind of strategy. And a lot of it is done corporately as well. But I have a lot of real estate investors that I work with just because of the area I'm in and the work that I do.
Mhm.
And more often than not, they'll come up to me and they'll say, like Zachary, somebody recommended I speak with you. That's how a lot of it starts, right? Referral basis, because I introduced it to one person who needed term insurance. I said, well, maybe you should think about this because you have a different need. Now, what is the need? They came to me and they said, Zachary, I have $7 million of real estate, right? I've invested, my parents left me real estate, whatever it is. I have a cottage and I want to leave it to my kids because who wants to sell real estate in Toronto, right? Well, what a lot of people don't know is on death, there's a disposition of sale. So that means whether you sell it or not, you're being charged tax on it. It's capital gains tax. So essentially 26% of your asset value, your growth is gone. If you bought it at a million, it's 2 million at death. Of that $1 million in growth, you're losing about $270,000, give or take.
That's a lot of money, Zach.
It is a lot of money. Okay, so then what do, right? Do you refinance the property? Why haven't you already refinanced it to buy more properties, right? Do you
Mhm.
sell it? Well, that's just an absolute shame. Why
Mhm.
not use life insurance? It's pennies for dollars in the sense that you put in pennies and you end up receiving dollars in the end. and that's just based off of multipliers and growths. Um, so what a lot of them are doing is they're coming to me and they're saying, listen, Zachary, I have an extra, you know, $30,000 a year in disposable income from my real estate portfolio, from my investment portfolio, from my
Nice.
job, right? Whatever, you know, maybe they're incorporated, they're a business owner, whatever it is. And I have this tax liability. Well, this is the best strategy for insurance, right?
Mm-hmm.
You have a need, which the death benefit covers. And on top of that, you have a policy that's going to grow, projected to grow at 6% a year in the lowest interest rate environment we've seen in 25 years, 30 years. So it's only going to go up in value, at least it should only go up in value. And so now what they do is they buy the policy, they get 90% cash value, and I go up to Duca Credit Union or Manulife Bank or Equitable Bank or, you know, one of the many lenders out there. And they say, okay, here's a policy. It's guaranteed, never going to go down. Once the money's in there, give them an annual loan advance against the value of the cash value. So what they've done is they've bought a life insurance policy that's going to grow essentially at 6%, give or take, tax-free in perpetuity. They've put in 30,000. I get them, let's just say $28,000 loan. It's cost them $2,000 in interest, which interest, if you use for productive purposes, for investments, for business purposes, it's tax deductible. So you use that now and you have two assets growing for you for the price of one.
So, Zach, let me ask you two real life examples of people that would come to you potentially, and how would you advise them on if infinite banking is for them or another form of life insurance? I typically see as a real estate lawyer, young couple, mid 30s, they bought their first house, they over leveraged themselves, they have this giant mortgage, then they also got two car payments, so they're leasing their cars, they got some lines of credit, they got 1.5 children. So let's say they're making combined around 200K. Let's just say that's where they're at in life. So that's what the income is at. They got this giant mortgage, they got car payments, all this other stuff. Is infinite banking for them, Zach?
Listen, at the end of the day, it's probably not.
Mm-hmm.
They have a bunch of temporary needs. So it's just like any type of planning, there's priorities, right? So number one priority for me always is disability insurance. Most people have it through their lines of work, so I don't necessarily need to worry about it too often.
Mm-hmm.
Um, but you're your greatest asset. If you can no longer work, you are in trouble. And the reason it's disability insurance is because statistically speaking, there's a way higher chance of you becoming disabled than of you dying at the age of 33 or even 43, right?
Is that only physical disability, Zach, or mental disability as
No,
well?
mental too. Mental, it's been
Mental too.
huge over the last
Oh,
2 years, especially. And I get claims reports all the time just because I want to see. And when I explain to people the advantages of it, mental health, there's skeletal is the number one claim for disability insurance, which is just anything related to your skeleton back area. And the second is mental health issues, depression, anxiety, stress, burnout, all of these things. And a lot of people don't realize that, but
mhm.
fortunately, I've had clients who have had to go and claim for these reasons as well throughout the pandemic, and thank God they had disability insurance, right?
Mental health is a real thing.
It's
Absolutely.
it's massive.
Yeah.
But for this couple, term life insurance would definitely be the first discussion. But it all depends on what we find in reviewing their situation. I don't anticipate them being able to do infinite banking given their salary, living in Toronto, and what they already have going on.
At what stage would this couple likely be in a position to be able to investigate infinite banking? Maybe in their 50s, once the mortgage is paid off,
Yeah,
perhaps?
I would say late 40s, early 50s.
Hmm.
What a lot of people are actually doing right now, and infinite banking, it's everything here in this realm has like 1,000 different names. But what a
Yes.
lot of people are actually doing is using this life insurance strategy as the very conservative fixed income portion of their investment, and then using it in retirement, right? So, and I haven't had the chance to do this just because I don't have too many clients who have utilized this, and just in the people I've worked with. But I worked and consulted on other cases because of my specialty in permanent life insurance, where I have a couple who's, maybe 51, 52. Their kids are at the point where they're growing up, they're become more self-sufficient, they have more disposable income. And they say, like, why would I invest in a bond that's going to make me 2% a year? Right.
Right.
Well, you're not wrong. Why don't we invest in life insurance? It's going to get you you know, and especially if you take tax into consideration, if it's projected to hit 6, for them, it'll probably hit 7 or 8%. And then in retirement, they get a loan against the value of their equity in their or the cash value in their life insurance. So it's growing much faster. It's so conservative that it's not, it's not worth, risking that much. So that's what a lot of people are doing in another form.